Hello, everyone, and welcome. I'm Kristen with TSIB. Here we are at TSIB's Construction Risk Management Seminar, Day 4. We are so excited to be here with you. I'm going to introduce our panel moderator in a moment, but first, a couple of housekeeping notes. This session will have a live Q&A at the end. We ask that you stay on mute and off camera during the entire presentation. Nick is our moderator today, so if you have any additional questions you'd like to ask him and have the panel be asked, you can post them in the chat feature located at the top right of your screen. This entire session, including the Q&A, will be available on TSIB's YouTube channel. And lastly, the material covered during this session presentation is for informational purposes only. It should not be construed as legal advice, and it is highly recommended that you contact your attorney for legal advice. So without any further ado, I'm going to introduce our moderator, Nick Langer, Senior Risk Advisor at TSIB, and he will be moderating the Alternative Risk Financing and Performance-Based Insurance Solutions panel session. We are so excited to have you with us today, as well as our panel speakers. I will now hand it off to Nick to begin.
Thank you, Kristen. I appreciate it. And thank you, everyone who's joined us for the last few days. Today, we've got two great people with us. Daniel Diaz, Managing Director at Travelers Construction, and Jason Oswald, President and Managing Director of Construction Insurance and Risk Captive of America. And I'll let, AKA CIRCA for short. Gentlemen, I'll let you guys give everybody just a brief who you are and where you've been. And some of the folks have seen Jason before, so I'll let Dan start and introduce yourself to the folks listening today.
Sure. Daniel Diaz, been with Travelers 15 years in the construction group. And then before that, I was in national accounts in two different other places. So about 25 years of experience, all large account focused. And construction's the most interesting and the most fun part of that.
Love it. Jason, you want to just reintroduce yourself in case somebody wasn't on earlier that gets to see you again?
That'd be great. My name is Jason Oswald, and I'm the President and Managing Director for CIRCA. My background is I've been in the insurance industry now for a little over 20 years. Started out on the P&C side, worked for a large national carrier, managing construction programs, their alternative risk, captives, professional pollution. Like Dan said, I love this industry. It's a great industry to work in, and especially for me in this alternative risk space, a really exciting place, especially in the market that we're entering. So I'm excited to be here and really appreciate the opportunity.
Thank you, gentlemen. So over the last couple of weeks, we've covered a variety of topics in risk management insurance. We started the seminar by discussing the current hard market conditions impacting underwriting process, pricing, availability of coverage and limits. And this afternoon, we're going to end things by talking about some concepts in alternative risk financing and performance-based insurance products. So, when it comes to, insurance, most people immediately think about or comprehend your traditional or guaranteed cost type of insurance program, right? In short, your business is ultimately presented to an insurance company as a risk, right? The insurance carrier underwrites your business, and they determine the appropriate rate to charge for whatever respective line of coverage you're acquiring. The rates presented to you as the insured, you agree to pay the premium, regardless of whether or not you have losses during the policy term. The policy ends and we start the cycle over, right? So that's what most folks are accustomed to seeing. With guaranteed cost insurance, your business is falling into this sort of global underwriting philosophy for the entire program, right? Or for the carrier itself. That's guaranteed cost insurance. And with guaranteed cost insurance products, right, we see the carriers directing all claims handling and claims decisions, the carriers controlling availability of loss control services, and ultimately market conditions are really driving pricing more so than individual rating factors. And the question becomes, how or when should I graduate, right, from a guaranteed cost insurance program, right, and begin structuring insurance solutions based on your performance, right? And I know we've all had the discussions with our clients where, someone says, I've bought insurance for X number of years and I pay X number of dollars and I've never had a claim, and over time my rates always go up, right? Well, that's because you're in a guaranteed cost program and your rates are being more dictated by market conditions and your actual performance. So when I'm talking to my clients, first and foremost, when we get to a certain point, we say, before you start considering any sort of loss sensitive or alternative risk financing program, it's imperative that your organization has an established and measurable risk management program. And I think both of you can agree to this sort of facetious statement I'm about to make, but there's a lot of contractors out there that say, we've never had a claim in 10 years. And then the next question is, well, what have you done? And say, well, we hire the best people. And the answer is, well, you're just lucky, right? We really haven't done anything that we can sit there and say, our program is better because, or we implement these things. So there is a difference between just having a good, run of luck and not actually having a loss in 5, 10, X number of years versus actually having measurable risk management programs, right? A safety culture that you've created in your company, which is, in my own opinion, the most important part of considering purchasing insurance or structuring a program outside of guaranteed costs. So when I'm having discussions with clients or prospective clients, we typically, use the number as like a sort of starting point. Once you get to about $250,000 insurance spend on any one coverage line, we should really start looking at other ways to finance our risk or structure our risk transfer. So I don't want to talk about our clients. I want to turn this over to the experts and say, and I'll turn to Dan. I'll start with you. So, when we're talking about a contractor who's looking to bet on themselves, right? Someone who's been around, they've got a track record. They say, you know what, forget this insurance stuff. We never have any losses. Well, there's got to be a better way to do this, right? What solutions exist outside of a guaranteed cost program? Like what comes to mind? What would you say is a good solution or starting point for someone?
Well, some of it depends on the state you're in, but let's assume it's California for these purposes. Any type of program that offsets a larger deductible so that not only the client, doesn't pay as much surcharges and premium taxes to the state, but also can get back some of that deductible immediately versus giving it to the carrier to earn whatever interest rate we get on that would be beneficial. And it really depends on size and what kind of appetite they have for risk. But the thing that you had said first is more of a comprehensive risk management program. You don't go to Vegas and play games that you've never played before. You go to games, and if you play blackjack, you know how to count cards. And if you do those things, or else it's just gambling. And clients that have a good track record and a good safety program, that's not gambling.
It makes a lot of sense. I like that analogy. That's
But
actually a great analogy.
It can be deductibles, it can be SIRs, it can be retros. I don't prefer retros because I think they're old and they are more like guaranteed cost, and you pay the same type of surcharges that you would do, as well as my counterpart will probably talk about group captives as well, as maybe a step in between. I think a lot of clients that are large grow out of group captives, because I think the advantages of deductibles and or a single parent captive outweigh those after a while.
That's great. So obviously you folks, have different, slightly different perspectives, right? You guys are sitting in different parts of the, the different sides of the industry per se. And I'm going to turn to Jason. I mean, do you have any, from your perspective and piggybacking off of what Dan said, I mean, what's your perspective when, you get to a point as a contractor and you've reached, we'll just say, a capacity, right? We're spending a couple $100,000 in premium, $400,000, $500,000, $600,000 in premium per se. and we have a good handle or understanding on our risk, and we're not just gambling, as Dan mentioned, right? I really I love that. What would you say? Like, is there a step? Is there, group captive, single parent captive? I mean, what's your opinion on that?
Yeah, and I would say, kind of the scenario you laid out where you're spending a couple $100,000, a single parent's not going to be an option at that point in time. But there are a lot of great captive options out there. Whether or not you're thinking about maybe some difficult exposures that you have on your books that is just hard to place, in the traditional market, maybe you're having to go to non-admitted markets. There's 831B captives, micro captives that you can leverage for those exposures. There's a bunch of great group captives out there, which I think are a great place for those type of contractors to start having the conversation. I think the key is trying to identify where you're going to be, 5-10 years from now. Because, one thing when you're looking at a captive and you're considering that as an alternative, it is a long-term commitment. So, you want to make sure that you're in a spot that you can grow and continue to leverage the retentions. Because, if you are betting on yourselves, you're going to gain more and more experience, and you're going to want to take on a little bit more. That tends to be the habit. When you're beating the house, we'll stick with the Vegas analogies here. You keep going back for a little more. So, so for me, I think the group captives are a great solution, and we can dig into that a little bit later. But it's, you got heterogeneous, homogeneous captives out there. They have varying retentions. So there's a lot of great solutions, for contractors of all sizes. Obviously, as they continue to get larger, that single parent is another attractive, captive solution. The key difference is you don't have, you're putting up all your own money in that scenario. In a group captive, you're going to have some sharing, which does help even out those results. We all know contractors work in a severity-driven business. A claim is going to happen at some point in time, and sometimes having that stability through a group captive is extremely beneficial.
So I'm going to divide you two for a second here, right? Because there's two different philosophies, right? And I'm speaking from the brokerage side of the house, right? A lot of times you have someone who's kind of hit this point, and we say this is guaranteed cost insurance is not the right solution. So then we have to get a CPA involved. Frequently, have to get the banker involved. If it's a contractor that has a bonding line, we need to get the surety broker involved to understand, right? Because there's capital requirements and letters of credit and stuff like that. So I'm going to ask you each the same question, but I'll start with Dan, and I'm going to say, so what would you say the benefit is? And let's just say your middle market, let's say $1 million premium spend. What is the benefit for a contractor to go with a loss sensitive? And let's kind of stick to SIR, large deductible type, and stay away from retrospective plans. But what would you say is the benefit to the contractor under that solution?
Couple benefits. One, the main benefit I would say is cash flow. Since clients in the construction side of the business have a return on cash anywhere between 15 and 20%, maybe even more, depending on what type of business they're in, not giving that to a carrier and just posting an LOC is tremendously beneficial. They put that money back into their business, and they will, potentially pay claims over time. But being in California and being in such a long-tailed state, that could be offset for many, many years. And let's call it just for comp purposes, 3 years. If you get return on 15 to 20% on your money for 3 years, or at least a portion of it, it's tremendous. So that's the biggest part of it. The other side of it is potentially benefiting from your own success. It is rare on my side of the business, even with contractors, even with the ebb and flow and cyclicalness of the market, they ever go to a deductible and have success and ever come out of it. I wrote an account 10 years ago. Well, no, it's 12 years ago now, where they had shrunk down to $300,000 of standard premium. They're usually running about $1 million. And I thought for sure they were going to go back to guaranteed costs just for that year because of the downturn in the economy and this and that. And they said, no, why would you think that? And I'm like, because you're only at $300,000. I mean, my deductible premium is, half of that. The amount of money you'd get back or save, and it was a $250,000 deductible, is minimal. And they're like, our last 2 years, we've had $60,000 of claims. So by your own measure, we would still make it out. And they did. They had no claims that year. So they were right. I was wrong. But my point is it doesn't always have to make sense to me. It has to make sense to the client. But yeah, the return on cash is probably the biggest differential just for contractors.
So then I'm going to flip to the other side, right? A different perspective slightly to Jason. And I'm going to say just personally that a lot of times in both of you, Jason, you've probably heard this more so than anyone. A lot of folks will view an SIR, a deductible program as a, I'm just going to use the term, a stepping stone per se, right? And I'm sure you've heard that, right? A stepping stone to go from a guaranteed cost program into a captive. So I'm going to let you go from there. Like, what's your philosophy on that?
Yeah, and we see a lot of accounts that do take that first step, taking a larger SIR or a larger deductible, and a lot of times it's because they maybe haven't found the right captive fit yet, or they feel that it's just too big of a step. I think one of the big key differences between the alternative large SIR deductibles, you still have a lot of the services coming down from the carrier into that program, whereas a captive, we've unbundled everything. We have our own TPA, we have our own risk control, where, there's a lot more involved in terms of owning and managing the captive that can sometimes, cause a contractor to hit pause. But my finding is that usually once they enter into that large deductible space, they're going to continue to build the resources around, because like Daniel said, they have that success. They see the value of, controlling their exposure and getting those returns and having their money invested, that again, they're going to continue to move that direction. So again, we see that. I would say that's shifting a little bit the market with it hardening as much as what it is. You see a lot more that are just jumping straight from guaranteed cost into group captives. I think the one difference in talking about the funds that you're setting aside for losses, our big difference is that we're still charging a premium for that. We're taking and we're holding it in a trust and then paying out those claims. So you're still earning investment income. You're still using your funds to pay claims. But there are some other tax benefits associated with having that come into the captive that I think are important to explore and understand, working with your CPA and your legal team and understanding what those pieces are. So again, we can maneuver accounts through, straight from guaranteed cost into a captive, or we can move them from a loss sensitive program or a large deductible SIR program.
So would you, either of you or both of you, say that going from a guaranteed cost program, making the transition to a deductible SIR type program is slightly more risk averse of a decision rather than going straight into a group captive where someone's willing to unbundle more and maybe accept a little bit more risk than is being accepted through that they're bearing on their own, or
So I actually, it's funny, Nick, I see it differently. I see it separately. What we have found is the stepping stone, from if you're a $250,000, $300,000 premium contractor between $1 million, group captives actually play a much better role in that space, 300 to 750, 800, because of the sharing the risk that Jason had talked about. You don't have to put the big boy pants on yet and take all your own risk, but you get some kind of benefit and a return, potentially if you don't have losses. We rarely find guys that are over $1 million or significantly over $1 million that still want to share with other contractors or other captive members their risk. because, as you know, contractors think they do it all the best.
The best.
No one else is anywhere
Nope.
similar to them. They have the best safety, have the best sale. So it is rare once you're big, especially if you're big in a group captive, you're the biggest or the third, fourth biggest, that they really are interested in sharing with some of the smaller group members. So I see the captives as a better stepping stone between that threshold. And part of the other reason is because my ability to offset and give them the better earn for taking a larger deductible, it is a size thing. The bigger they are, the better chance they have to earn more. So if they're $400,000, $450,000, I would argue a group captive, if they're really looking to take risk, is a better option than taking a big deductible with me.
That's interesting. Jason, what's your thought?
And you know, I appreciate the plug for those middle market accounts. You know, that 250 million. I think there is truth in the statement for the larger. I think there's a smaller pool of group captives that can actually do the retentions in a way that they still get a lot of value. And I'll plug CIRCA here just a little bit, but you know, I think we're really unique in terms of what we are willing to take on from an exposure standpoint. So, you know, for those larger contractors with a more significant loss pick, you know, when we're taking, you know, 550,000 of the first loss, and then, you know, building a tower up to 5 million and taking another 1.3 on top of that, then we start getting real attractive for the larger accounts. And you know, there's still a way to spread that risk, you know, and share it in a way. You get that that peer group interaction, which I think is extremely valuable in a contractor setting. Like you said, they're all competitive, and that's one thing that I love working, you know, with these guys is, you know, they're not happy with their results from, you know, yesterday. They're going to continue to push and try to drive it down further and further. I mean, their goal is zero losses, and we all know that's not possible, but you know, that's ultimately what they're striving for. So again, I think it really depends. For those larger contractors, I think it's a little more due diligence in looking at captives, understanding, you know, what their growth strategies are. You know, finding a captive maybe where you start out with a, you know, 250, 350,000 retention is great. But if your goal as a company is to double in size over the next 5 years, you're going to outgrow that captive. Now you've got a situation where you're leaving capital behind so that you can transition to another program, and that's not a lot of fun. No one likes doing that. So I think, you know, interviewing the captive as much as they are interviewing you is critical for those larger contractors to understand, again, what that long-term captive play is.
So this is good. I like this because I'm glad we have both of you joining us today, because I look to both of you as being responsible underwriters per se, right? And making sound decisions. So I like where this is going between the two of you. So I'm going to go. So this is a slightly loaded question. So I start with Jason this time. Jason, and I'm going to say this is exclusively as respects the perspective of CIRCA, not a general statement, but as respects from CIRCA's stance. What is the right type of contractor or fit for CIRCA? I'm just curious. You know, like what would you say is the right type? Is there a certain trade? Is it volume based? Is it what would you say?
Yeah, and I would say CIRCA falls more on that unique side. You know, we worry less about the, you know, trade. We're not going to build up with, you know, just one class of business. What we're really looking for is a contractor and a set of owners that are actively involved in the management of their company. They're taking an active interest in claims and in risk control now. They're investing in both of those areas. You know, from there, you can go into a lot of different risks, whether it's petrochemical, you know, some blasting, or, you know, if you want to go more traditional GCs and electrical, mechanical, you know, you can find the right risk. You know, we constantly have some accounts that are on that fringe, and I love looking at them because, you know, what they bring to the table for us is a unique perspective. When you're dealing with exposures with a little bit of hair on them, and you got owners that are actively involved, they're developing programs, risk control programs, claims practices that I know are going to benefit the rest of my members. And I've mentioned the peer side of it, and that's a huge piece, at least what we do in CIRCA. So to say, a specific type of business, that's a little more difficult. But again, I think that characteristic of the owner is the most critical piece for us.
And I'm going to ask you the same question, Dan, from your perspective, where you sit. I mean, let's talk about an SIR deductible. Let's just stick with that for this conversation. What would you say? What are you looking for from your perspective to say, hey, this is a good decision? Or if a broker like myself brings an account to you and they say, hey, we want a quote from Travelers for, this X, Y, and Z contractor, what would prompt you to say, hey, have you thought about, right? Or maybe we should be looking at this. What are you looking for from your perspective?
Not unlike what Jason talked about, a client that is got a good, strong risk management program, is interested in being involved in our program. As you know, Travelers Construction has dedicated risk control, dedicated claims, all to construction. And it is really meant to draw the clients in. If the client is not, if the client's not interested, they want to pay the premium and walk away, that doesn't really work for Travelers. We know that best outcomes come with collaboration and communication. Our longest tenured client is over 65 years. So it's because they're invested. And so those are the kind of things. From a class standpoint, I would tell you it doesn't really matter. Now, I would say send Jason all the blasters and the petrochemical.
You want all the commercial electricians?
we write the most commercial electricians in the state. So yes, most of them are large. But no, but I mean, the thing that defines the Travelers Construction clients are they're focused. They're invested in their clients and their employees, and their reputation and is probably the most important thing to them. So that drives a certain type of behavior.
That's good. So I baited both of you because I wanted to be able to make this statement with support. And this is something that I think you both will understand this, because I know, Jason, you and I have talked, and your increase in submissions, right, for people interested in joining the CIRCA captive has increased exponentially. I think it's fair to say. Daniel, on your side, I know in talking to the folks we work with from your team, submissions have gone through the roof again. And what we see from our side of the fence, there's a lot of folks that in my opinion, are taking this hard market situation and they're desperately trying to find another way to save money or to reinvent themselves. And so what we're seeing frequently is someone who's saying, and I just had this discussion with a client, it's actually a mutual client of one of ours, and they said, I want to see my renewal, and I want 3 quotes, and I want you to give us a captive, and I want you to give us a deductible plan. And, and then that was the discussion. And I said, well, let's go back, because I can't compare a horse, a motorcycle, and a car, because that's kind of what we're talking about, right? We've got your horse, we've got and I'm not going to determine which one of you is the motorcycle or the car, but I think we can all agree the guaranteed cost program is the horse, right? So, and that's where I want to get to the folks listening today. I think it's important that you understand the stuff that we're talking about. This is not a decision to be made side by side where we're comparing your traditional guaranteed cost insurance program from Travelers to Zurich to Liberty Mutual, and then our fourth option is the CIRCA captive, right? I very much impose upon people, we need to determine first and foremost whether we can absorb any of these first dollar risk costs ourselves, right? Are we in a position to structure a program, whether it's an SIR or a captive? Then we can go back and interview and have discussions with captives, or we can talk to the Travelers or the Zurichs or whoever it is of the world about, hey, this is what we're looking to accomplish with our program. So I appreciate you allowing me to give that little soapbox speech there, because we're seeing that a lot right now. And I don't know, maybe you can attest to this or not, but we are seeing where it's kind of, when the market gets hard, people are looking for another solution. And then you kind of have sometimes from the broking community, I think sometimes a little bit of an irresponsible sort of knee-jerk reaction of, oh, hey, let's go into a captive because of X, Y, and Z, or let's take on a deductible. And you have an insured that's in a situation where they don't really comprehend fully the financial impact of still having losses potentially and having to fund some of those losses on the front side. So it's a very serious discussion that should involve your CPA, your banker, and your surety broker. So with all that said, Jason, or I'll go to Jason. Jason, have you seen any changes in buying philosophies or strategies? Are you seeing other lines of coverage that you didn't necessarily see presented? What are you seeing from your side right now? Because obviously the market's impacted everybody differently, but it's impacted everybody.
Yeah, I mean, we've seen a huge flow of accounts starting to come our direction. We're still pretty much seeing the same standard lines, work comp, auto, and GL. I think what this market has done is it's flushed out maybe a couple larger accounts that are, maybe a 2-line. A lot of captives look for all 3 lines to come in. And I think one thing that we've started to look at is, with this market moving as quickly as what it is, starting to look at a, work comp GL only play, or a work comp and an auto, which is a little bit of a different view. But we're not really necessarily looking at, bringing in any kind of like professional exposures or any of the property exposures. Those 3 lines tend to perform extremely well within a captive. They're, especially that work comp and the GL, longer tail lines, you get more investment income off the monies as they're sitting in the captive. So that piece hasn't changed. We are, definitely competing against more captives. I mean, what you said, Nick, in terms of, hey, I want 3 captive quotes and lay it out for me and let me go at it. And my one big, a piece of advice to those contractors is I'm happy to do a historical comparison. I can do that quickly and easily. That's not a problem. But as I said at the beginning of this conversation, you really do want to interview the captive. You don't want to just put someone down in front and make a decision just based on the numbers, because the captive is an extension of your business. I mean, you are owning a piece of an insurance company, and you want to know who you're in business with and the partners that you have. So, trying to get people to slow down and go through that process, I think is key. Now, as this market continues, you're going to see, maybe some other, smaller captives pop up to address some of those ancillary coverages, whether it's, health benefits, maybe looking at, deductible reimbursement captives for some of those other larger or harder to place exposures is great solutions. So you're going to see that kind of come into play. But for us, currently right now, no notable changes in the program that we're offering, other than, I guess if we want to go this route, and maybe this is opening up too big of a can of worms here, but the excess market, it's really looking at what you doing with the captive again. How are you structuring the captive with the limits that are being presented, the retentions within there. That I think is changing buying philosophy just a little bit.
Do you think, you mentioned something about you mentioned deductible buyback, right? So would you, in your perspective, let's say you have your sort of middle market contractor, right? Let's say, you're about $1 million spend for, let's just say it's the work comp line, right? You've got $1 million spend for comp. We have an SIR program, $100,000 SIR. The insured's purchasing a deductible buyback policy, right, to sort of hedge their bet and per se, which is sort of counterproductive sometimes in my opinion. But would you say that the deductible buyback piece is, structuring a captive for the deductible buyback or putting that into a captive? Would that be a way for the insured or the contractor to start moving their way into a captive? Is that a transition point? Does that make sense? Or
yeah, I think that's more of a transition point for an extremely large contractor that might be thinking, right, hey, I'm going to go down the path of a single parent at some point in time. So I'm going to go ahead and invest in getting the cell set up. I'm going to start doing a deductible reimbursement and then eventually transition it into a single parent. To just do it in the way that you described, no, I think for most contractors, that's not the case. Where we're seeing a lot of activity in that piece, the deductible buyback programs, is with SDI coverages and OSIP CSIPs is, them trying to say, okay, listen, we're going to buy SDI with $1 million retention, and we are going to charge, ourselves and our clients, an X amount of rate and hold a percentage of that back. That is actually, driving a lot of interest right now. So I think it's those two pieces. Either someone that's going to eventually go single parent, it's a great introduction piece, or someone that's looking again for some of those ancillary coverages.
Excellent. Dan, from your side of the house, have you guys seen notable change in buying philosophies or program strategy? What are you guys seeing?
We are seeing the setup that you started off with. Hey, I want this, try to give me everything. And I appreciate that actually your first statement was to turn it back on them and saying, okay, what are you ready to take risk in? What are you really looking to buy, and this and that, the other, because anyone that wants a deductible doesn't necessarily always want a deductible on every line.
No.
Maybe they don't want a deductible on auto, or maybe they don't want a deductible on GL on auto, just on comp, or vice versa. We've had risks in here that only have a deductible on auto. So I think having knowledge on the client of what their needs are and where they're trying to offset their program to save a little bit of money, but also to actually get some return, is paramount. That also kind of dictates what type of deductibles you put on. There's certain clients that have come out of captives that my first inclination was to put them on a $250,000 deductible across the board. And their response was, no, I was taking a $450 if you add up all the different A, B, and C funds. And so give me a $500,000 deductible. I want to save some money. So, really understanding where the client is and what their needs are is paramount to putting together a program. In addition to that, has things changed along those lines? I think interest has changed. And part of that interest, and Jason alluded to it right at the end, is being driven by umbrella and excess. It is very hard, very difficult to place at the moment, much more expensive than it used to be. In addition, I think Travelers on the other side is looking to write all lines. So I would tell you auto, GL, comp, umbrella, property, inland marine, professional, pollution, we want it all. It doesn't all have to be on a deductible. But if we can write 9, 10 lines, absolutely. Then we're all dialed in. I mean, you and I know, Nick, you always want to put your professional where your GL is. So there's no argument. It's kind of the same thing on the umbrella. The primary umbrella, it's better to be with the primary GL line. So you have control over who settles the claim and how it gets done. So there's a lot there, but it really depends on the client and the flexibility you need to get them what they want.
That's great. We're getting down to the end here, and before we go into Q&A, I'm just going to ask both of you a very general question, I'll go back to you, Dan, just to start with you. If you had one piece of advice to give to your average middle market contractor right now, prior to their next renewal, I'm not talking 90 days out when we're scrambling and trying to put submissions together, but if someone who renews next March 1st, right, of 20, what advice would you give to them right now, given current market conditions and what you're seeing? And do you have a sort of global advice for anyone right now in the construction industry?
Boy, that's a really broad question.
Since
we're talking about deductibles.
Yep.
The easy rule of thumb that everyone on the phone should know about is, if you ever get a quote on a deductible of some kind, regardless of the size of the deductible and everything else, if you take that deductible, you look at your own losses going back 5 years and that premium, and if you can make money, even if it's marginally, make money 3 out of 5 years, then you belong on a deductible plan. If you cannot make money, or you have really bad losses a couple of the years, or you're not up in dollars, then you're not ready. Simple as that.
It's great. No, it's great advice. Jason, what about you? Do you have any sort of words of wisdom without a crystal ball or a magic wand?
And I think it's what you said. The key is starting the conversation early. There's a lot of moving pieces in these options, and I would say with group captives, there's a lot of different directions you can go. And if you're large enough to where you're evaluating a group captive or a single parent, you don't want to rush into that conversation. Yes, this market's hard. You're starting to see some pretty significant rate increases, and the impulse might be to jump out quickly. And there are those accounts that can make that transition extremely fast. But I think doing your homework and making sure you know what you're getting into, because you're going to be asked to put up a lot of capital and tie it up for the foreseeable future, within a captive or even, a large deductible SIR program. So I agree with Dan. Do the historical comparison, understand, what's working in your program, what's not. I see with you all, Nick, you and your team, I mean, sometimes we identify accounts that, they're going to be a great fit for a group captive. In 2-3 years, once they clean up a little bit of work, do a little bit of work on risk control or in their claim side. And that's a good conversation to have. I mean, it's like when you're selling a house, you just don't flip it on the market and let people walk in and see how you live your life day to day. You're fixing things up and getting ready for that next step. So that's the one thing I would say, don't be afraid. I mean, we field those questions. We do those historical comparisons all the time. I enjoy doing them and having those initial conversations because, it gives us an opportunity to learn about the contractor learn about us and just what captives are. So start early.
No, that's excellent. That's great advice from both of you. And I want to thank both of you for your time this morning, this afternoon, depending on what part of the country you're sitting in, listening. And I'm very glad that there was a lot of synergy between the two of you. We both highly respect Daniel and your team at Travelers and Jason at CIRCA. We've enjoyed working with both of your organizations over the years. And I'm glad for those of you on the phone listening, you were able to hear that, this should not be a magic bullet sort of decision for you at this point in time. So please have in-depth conversations and make sure that you are going into one of these decisions eyes wide open and you have an understanding of the risks that you are accepting moving out of a guaranteed cost insurance program, and you're not just looking at the upside, because there's two sides to this decision. So Daniel, Jason, I appreciate you guys joining us this morning, and I'll let Kristen wrap it up here and we'll go from there. So thank you very much to everyone listening.
Thank you.
Yes,
Thank
your
you.
panel was great. It was extremely informative. We do have a few questions that trickled in. So to the panel, one question is it better to transition from my traditional insurance program to a large deductible program before going into a captive? Or is it better to go straight into a captive?
I would say it depends on size.
Okay.
No, I mean, really, truly, I
Yeah.
think, I think Jason would tell you, captives have really competitive options depending on what type of line you want, between 300,000 and 800,000. I would say deductible plans start to make a lot more sense after that, and they start to, the savings on cost of cash is tremendous after that.
Okay.
And I would agree. I mean, you can do it both ways. I think, that for some people, it's a little bit easier to get into a deductible or an SIR. I think, we stayed on deductibles and SIRs, but if you get into retros, those get a little more complicated to move out of and into captives, because you got the unwinding, of that program and the tax implications. You got to understand that piece a little bit more. But again, I think it's going to be unique to the to the shareholder, the contractor, in terms of what step they want to take. Selfishly, I prefer just jump straight into captive.
That's fair enough.
Another question that came in is, what happens if I go into a captive or a loss-sensitive program and want to switch after a certain period of time? How hard is it to switch insurance programs once we go down one of those roads?
I would say, that's got to be part of your due diligence when you're joining, at least on my side, on a group captive. You got to get their private placement memorandum. You got to look at their bylaws and what those rules look like. When you exit a captive, you got to keep in mind that they no longer have inbound premiums, so they're likely going to increase the collateral, the confidence level that they're going to hold collateral at, which means you're going to be posting a little bit more. They're also going to be a little more reluctant to release some of those dividends and collateral in those early years, because again, they need to protect those longer tail lines of business, the work comp and the GL. So, understanding what those bylaws, how they read and how that works is going to be important. The other piece too is, for CIRCA, for example, it's not something that you're just going to buy into in year one and then want to jump out. There's penalties for leaving early, within the first 3 years that you need to understand that piece extremely well, as on top of the collateral piece. So, can you exit? Do we have companies that have exited? Yes. For us, it's usually when they get bought out by another entity, and the new entity is no longer going to stay in a captive, that we see people exiting, and that's the discussion we have is around that collateral requirement is the big piece.
From the traveler side, we don't have any of those penalties. We have clients that go from a large loss sensitive program to a guaranteed cost, back to a large loss sensitive program. Sometimes they do it during the year. So as long as they stay a traveler's insured, they can adjust their program as they see fit.
Good.
Would it be safe to say, I'm going to ask this in response to both of your answers, would it be safe to say that if a contractor is looking to go into some form of a loss sensitive program or into a captive, that part of that thought process should involve how I am able to, or what I'm able to? And if you're thinking that I only want to do this short term, is that maybe not the right direction? If you're thinking I only want to do this year because of X, Y, and Z, or is it different philosophies for both of you? Because it sounds like it's sort of a different philosophy.
Yeah, and I think what Jason would tell you is when you're becoming part of a group captive, you're becoming part of the community, and you have responsibilities to that community. When you're looking to a deductible plan with Travelers, your own program, you only owe yourself. You don't owe everybody else, and so that's why we don't have those types of things where you have to tell us a year in advance or whatever, because it's your own program. You can buy and decide what type of deductibles you want. You can have them higher, you can have them lower, you can go back to guaranteed cost.
Excellent.
Yes, thank you guys. Another question that came in is, if I have a captive, will I have any issues with my insurance compliance on my projects?
No, and that's the beauty is, for us, our fronting paper's Arch, the captives that are done through Travelers, that they're going to be the fronting paper there as well. So, you're buying that A+ paper, the financially rated and AM Best, type carriers. So, you're going to be able to comply with all your contractual requirements, because ultimately that's what gets shown, to the owners, or the project owners. In the event that you have a loss, it's going to look like Arch or Travelers or whoever the fronting carrier is the one engaging. What's happening behind the scenes is there's a reinsurance agreement where the captive is assuming part of the risk for the policies that are being issued. So no, that's the beauty of the captive is again, you still get the strength of that paper, and we're just taking on a portion of the risk.
Great. I don't see any more questions. So I'd like to thank our panel and our moderator today. You guys did a fantastic job. I'd really appreciate you guys taking the time to spend with us, and our audience members, we really appreciate having you here. We hope you enjoyed this session along with our entire seminar. Stay on the lookout for more educational webinars in the future. And if you have any questions about the panel, what they said, our additional sessions, please reach out to us on our website at tsibinc.com. And thank you all again for joining us. Have a great day.
Thanks, Kristen.
Thank you.
Dan, thanks. Thank you. Jason, thank you very much, gentlemen. Have a good day.